You're listening to Uranium Spotlight Podcast, sponsored by PurePoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's Tuesday, November 18th, 2025, and this week on Uranium Spotlight, spot prices soften despite active trading. Finland and Turkey confront their nuclear fuel vulnerabilities. India accelerates reactors sitting nationwide, and Skyharbour announces a major multi-JV deal with Denison at Russell Lake. Last week, the uranium spot price opened at $77.20 a pound and closed at $77, a slight softening despite an unusual busy trading window. The week began with buyers testing the market as offers slipped toward the mid-70s. 4 spot deals were confirmed on Monday, lifting the daily price to $77.70, followed by a high of $78 on Tuesday. Midweek activity flattened. Wednesday saw no transactions, and Thursday's modest offers drifted down to $77.50 with a single trade recorded. The notable shift came on Friday as sentiment cooled and participants met tighter bid-ask spreads. Multiple buyers stepped in, and 4 additional spot transactions were completed, ranging from $77.25 down to $76.50, depending on the delivery point. By Friday's cutoff, blended pricing settled at $77 a pound, with location premiums narrowing across Cameco, Coverdine, and Orano. A final Orano delivery transaction at $76.90 arrived just before 4 p.m., bringing the weekly tally to 13 confirmed deals totaling just over 1.2 million pounds. For investors, the key takeaway is that the market remains physically active even as prices step down. Trading volumes suggest no lack of buyers, but offers are thinning and reacting quickly to short-term shifts in sentiment. The steady contracting and optimistic purchasing we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when the uranium's real move is about to start. Get it now at uraniumspotlight.com. Finland has spent the last 3 years working to eliminate Russian influence from its energy system, but nuclear fuel remains its most stubborn dependency. Even after replacing Russian oil with a Norwegian supply and shifting LNG imports offshore, Finnish reactors, now providing 39% of national electricity, continue to rely heavily on Russian uranium. For Finland, this isn't about geopolitics alone. It's about supply security. A professor at the University of Helsinki recently noted that Fortum has tried for years to source non-Russian uranium, but has repeatedly failed. The problem isn't policy. The problem is that there simply is not enough global uranium available from trusted suppliers. Finland's challenge illustrates the broader structural reality in the Western fuel cycle. Nuclear buildouts are accelerating, but greenfield uranium production has not followed. When a country with one of the most advanced energy security strategies in Europe cannot access the pounds it wants, the world has a problem. Finland's urgency is amplified by its new position at the energy frontier of NATO. The strategic motivation is clear. No Western-aligned nation wants to depend on Russian material for baseload generation. Yet in practice, shifting away from Russian origin pounds requires supply that does not exist today at scale. For investors, this matters because Finland is a visible example of constrained Western accessible supply. It reinforces that without higher prices to incentivize new production, geopolitical realignment simply cannot happen. The gap between what nations need and what the fuel cycle can currently provide continues to widen. Turkey has long walked a complicated geopolitical line between Russia and NATO, but last week's comments from the Turkish energy minister represent a rare admission. Turkey is wholly dependent on Moscow for its nuclear fuel and heavily dependent on Russian natural gas. Ankara's flagship nuclear project leaves little room for diversification. Under the build-own-operate model, Rosatom finances, builds, owns, operates, and fuels the entire plant. The agreements are locked in. The pathways are fixed. The dependence is absolute. Turkey now says it wants to diversify future fuel arrangements, but officials offered no specifics and acknowledged that diversification is impossible. If Turkey wants a strategically independent nuclear sector, it must build its next reactors with different partners and begin the process independently. This situation stands in contrast to Finland and even Hungary, both of which have recently secured Western origin fabrication and diversified procurement channels. Turkey, by comparison, continues to court Russian favor even as it signals concerns about over-reliance. The deeper issue is not political positioning. It's convergence of technology, fuel supply, and national autonomy. In a world of growing electricity demand and heightened geopolitical risk, the country that controls your uranium controls your grid. For investors, this matters because it shows how quickly national energy policies are being reshaped by supply constraints. As new demand centers emerge across Eurasia, access to diverse, credible uranium supply becomes a form of strategic leverage, and countries without it can be forced to make reactive, not proactive, decisions. India's largest utility, the state-owned NTPC, has begun sitting work across 16 states for a major nuclear program aimed at delivering 30 gigawatts of capacity by 2047. India's national target stands at 100 gigawatts, meaning NTPC alone is expected to provide nearly one-third of the country's nuclear future. The scale is enormous. NTPC plans reactors in three sizes: 700 megawatt units for smaller urban centers, 1 gigawatt reactors for mid-sized cities, and 1.6 gigawatt large units similar to Finland's newest plant. A single 1 gigawatt unit consumes roughly 440,000 pounds of U3O8 a year. India's stated ambitions imply sustained long-term structural demand. NTPC is already securing raw materials and exploring overseas uranium assets, a signal that India understands the fuel constraints emerging globally. Meanwhile, its partner, NPCIL, continues to operate India's existing 24 reactors and recently expanded cooperation with Rosatom to build additional units. Unlike Finland or Turkey, India does not show strong anxiety over Russian involvement because its nuclear sector is majority state-controlled and domestically anchored. Still, India's growth path will require significant uranium commitments from abroad. With hundreds of millions of new consumers entering the middle class and electricity demand accelerating, nuclear is the only large-scale, non-intermittent option capable of meeting long-term needs. For investors, this matters because India represents one of the largest future drivers of uranium demand. As sitting progresses and reactor procurement begins, India will become a persistent presence in the global fuel market, adding long-term competitive pressure to an already thinly supplied pipeline. Skyharbour Resources announced a landmark strategic agreement with Denison Mines that restructures the Russell Lake project into 4 new joint ventures with combined potential consideration of up to $61.5 million. Denison will acquire initial interests ranging from 20% to 70% across the RL, Jetty East, Wheeler North, and Wheeler River claims, with options to increase ownership through staged expenditures and cash payments. Skyharbour receives up to $21.5 million in cash or shares, including $18 million before year-end, which immediately strengthens its exploration and corporate budget through 2026. Denison commits to at least $4 million in near-term exploration and will fund its pro-rata participation at RL until total spending reaches $10 million. Skyharbour remains operator at both RL and Jetty East during early earn-in phases, while Denison will operate Wheeler North and the Inlier projects. The transaction formalizes a partnership that aligns 2 of the most active uranium teams in the eastern Athabasca Basin. It also recognizes a large geological complex land package into targeted, independently advanced exploration hubs. With major structures, prospective conductors, and historical mineralization across multiple zones, Russell Lake now benefits from the combined technical strength of both companies. For investors, the key takeaway is this. The agreement is a significant validation of the district-scale potential at Russell Lake. Denison's willingness to deploy capital, assume operatorship on key blocks, and commit to a multi-year earn-in reflects confidence in the upside. Skyharbour strengthens its treasury, retains meaningful ownership, and gains a powerful technical partner across a large portfolio while continuing to advance Moore and the RL claims directly.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.